So right now, traditional higher education is facing what you could reasonably call a slow motion financial apocalypse.
Yeah, that's entirely accurate.
Right. Like accreditations are just being pulled left and right.
Oh, absolutely.
And these legacy campuses with, 100-year histories are just quietly closing their doors. Chaos has basically become the absolute baseline.
It's wild to watch.
It is. I mean, if you look at the landscape, it looks like a demolition site. But what if I told you there's one education stock treating this massive industry collapse not as a crisis, but, as a high-growth tech opportunity?
It's a really remarkable divergence in a sector that we typically associate with like massive institutional inertia.
Right. They move so slow.
Exactly.
Right.
While the traditional players are struggling just to, keep their lights on, we are witnessing a massive transition in market leadership.
Just a total changing of the guard.
Yeah. And this transition is being driven by technological breakthroughs, sweeping regulatory changes, and just severe macroeconomic pressures that are fundamentally breaking the old models.
Well, welcome to this Talk Tickers deep dive. If you are a retail investor trying to cut through the institutional Wall Street jargon, you have absolutely found your home.
Glad to be here.
Our mission today is to take a massive, unvarnished look at the Q2 2026 earnings call for Grand Canyon Education. For those of you tracking along, that is ticker symbol LOPELE.
And we are not just going to skim the surface of this earnings call.
No, definitely not.
This specific quarter actually serves as a masterclass in how a company can completely re-engineer its business model.
Right, and just totally widen its economic moat.
Exactly, and aggressively allocate capital while its legacy competitors are quite literally facing insolvency.
So the game plan today is comprehensive. We are going to dig into the headline numbers, the revenue, the earnings, the margins.
The fun stuff.
Right, the fun stuff. And then we are going to spend the time you actually need to understand the mechanics behind those numbers.
Because that's where the real story is.
Exactly. We will look at how management is weaponizing their balance sheet for the rest of 2026, and we will land on an actionable bottom line verdict for you, the retail investor.
Sounds like a solid plan.
But before we get to the spreadsheets, let's talk about that apocalypse I mentioned. What exactly is happening to the legacy incumbents right now?
Well, to appreciate the structural advantage of Grand Canyon Education, you really have to look at the broader environment they operate in.
Right, the macro picture.
Yeah. Just last week, WAC, the Western Association of Schools and Colleges, which serves as the regional accrediting agency for higher education institutions out west.
Well, then gatekeepers.
Exactly. They placed 4 prominent universities on a formal warning status.
Okay, a warning status. For a university, that isn't just a slap on the wrist, is it? I mean, that is a potential death sentence.
It really is. It's the final alarm bell before a death sentence.
Yeah.
To explain the mechanics of this to the retail investor, an institution's survival is entirely dependent on accreditation.
Right, because of the funding.
Exactly. If a school loses its regional accreditation, its students instantly lose access to federal financial aid.
Which means no Pell Grants, no federal student loans, all of it just gone.
Poof.
Sure.
Gone. And without federal aid, enrollment just collapses overnight and the school goes bankrupt.
Right.
So when WASC puts 4 prominent Western universities on warning status for extreme financial instability, it sends an absolute shockwave through the entire sector.
And I mean, small private universities have been closing for decades, right? That's not entirely new, but the rate of these closures is accelerating dramatically right now.
It is, and it's accelerating because the economic pressures have fundamentally changed.
How so?
Well, higher education has traditionally been an industry insulated from rapid market forces. But right now, due to demographic shifts like fewer college-age students and the rising cost of capital, market leadership is transitioning at a record pace.
Yeah, that makes sense.
Grand Canyon Education CEO Brian Mueller used a really fascinating phrase on the call. He referred to the current environment as being plagued by chaos fatigue.
Chaos fatigue. I love that. I want to linger on that for a second because it perfectly captures the psychology of the market right now.
It really does.
If you are, say, a faculty member or an administrator or even a prospective student at one of these legacy institutions, you are just constantly worried about budget cuts, program eliminations, and sheer survival.
Which completely paralyzes decision-making.
Right.
Legacy institutions are just bogged down by this chaos fatigue, losing massive amounts of ground to leaner, technology-native competitors.
Competitors who aren't burdened by, like, deferred maintenance on a 150-year-old campus.
Exactly, or massive administrative bloat.
Which brings us perfectly to the core data for LOP. Let's fire off the Q2 2026 headline numbers, because they paint a picture of a company that is entirely immune to this chaos fatigue.
Yeah, let's hear the numbers.
Okay, Q2 service revenue hit $264 million. That is a 6.7% year-over-year increase compared to the second quarter of 2025.
Not bad at all.
Not bad, but the real fireworks were on the bottom line.
Oh, yeah. The bottom line metrics are where the operational leverage really shows up.
Non-GAAP diluted earnings per share, or EPS, came in at $1.81. That is a massive jump from the $1.53 they reported in the prior year.
Huge jump.
And here's the kicker for the retail crowd. That $1.81 beat Wall Street consensus estimates by a solid 14 cents.
Beating consensus by 14 cents in a quarter, that is typically the seasonal low point for higher education.
Right, the summer months.
Yeah, the summer months. That is a very aggressive signal of underlying strength. But we should pause and clarify a term you just used for our listeners.
Oh, sure.
You mentioned non-GAAP earnings.
Right, yes. Let's translate that Wall Street jargon. When a retail investor reads an earnings report, they usually see GAAP and non-GAAP. What is the mechanical difference there?
GAAP stands for Generally Accepted Accounting Principles. It is the standardized, rigid rulebook for corporate accounting.
The official rules.
Right. GAAP numbers include absolutely everything, including one-time charges, weird tax adjustments, or, non-cash expenses like the amortization of intangible assets.
Okay, and non-GAAP?
Non-GAAP, on the other hand, is when management strips out those one-off accounting artifacts to show you the raw recurring profit of the core business.
Okay. So GAAP is the literal rule book, but non-GAAP is often the clearer picture of how the actual engine of the business is running on a day-to-day basis.
Essentially, yes. Wall Street relies heavily on non-GAAP figures because they provide a much better baseline for predicting future cash flows.
Got it.
And in this case, the core engine of LOP generated $1.81 per share, blowing past expectations.
But numbers on a spreadsheet only tell part of the story. I mean, you can grow your revenue by spending irresponsibly on marketing, which just destroys your profitability.
Right. Anyone can buy revenue. Yeah.
Exactly. But LOP didn't do that. I want to talk about their margins. Their operating margin came in at 22%.
Very strong.
And according to the transcript, that represents an expansion of 110 basis points. Let's translate basis points and operating margin for a second.
Sure. A basis point is simply 1/100th of 1%.
Okay.
So an expansion of 110 basis points means their operating margin grew by 1.1% over the previous year.
Right. An operating margin is basically what percentage of your revenue is left over after you pay for the actual cost of running the business.
Salaries, marketing, technology, rent.
Exactly. Let me use an analogy here to make the mechanics of this clear. Think about it like a restaurant.
Okay, I'm listening.
Growing your revenue by 6.7% is like getting 6.7% more customers walking in the door and ordering food.
Right.
But expanding your operating margin by 110 basis points means you also figured out how to make a slightly higher profit on every single one of those meals you serve.
That is a perfect way to visualize the mechanics of operating leverage.
You are growing the top line and becoming more mathematically efficient at the exact same time. It's like the holy grail of corporate finance.
It really is.
So looking at the Q2 data, how did they actually pull that off? Where did that efficiency come from?
Well, the 110 basis point margin expansion was primarily driven by a significant reduction in general and administrative expenses as a percentage of revenue.
Okay, so they cut costs.
More like they scaled efficiently. They're scaling their technology and their administrative processes across a larger student base without having to hire a proportional number of new administrative staff.
Oh, that makes sense.
And this efficiency was only partially offset by some new strategic spending on partner initiatives.
So they grew their operating income by 12.4%, hitting $58.2 million for the quarter.
And that is the ultimate takeaway from the headline numbers.
Right.
When you see a company like Grand Canyon Education expanding margins and growing operating income by double digits, while its regional peers are getting warning letters from their creditors regarding insolvency.
Right. It validates the entire investment thesis.
Exactly. LEPE is taking market share rapidly.
So they've got this incredible top and bottom line momentum, but as investors, we need to drill down into how they are actually pulling this off operationally.
They didn't just get lucky.
Right. It wasn't just generic marketing. This brings us to the story behind the numbers. Let's talk about where this growth is actually coming from.
It comes down to a highly targeted, almost surgical strategic shift.
Okay.
Total partner enrollment was up 7.6%, which is healthy. But the real stars of the show, the growth engines that are actually expanding those margins, are the specific degree tracks within their hybrid model.
I really want to dig into this hybrid model because this is where the unit economics start to sound like a tech company rather than a university.
Oh, definitely.
Hybrid campus enrollment grew 8.5% year over year. They are now sitting at nearly 6,000 students spread across 47 active physical locations.
Huge footprint.
But here is the critical financial metric for anyone holding this stock revenue per student.
This is the linchpin of their entire long-term growth strategy.
Let's hear it.
The revenue per student for these hybrid programs is more than 3 times higher than the revenue generated by their traditional, fully online students.
3 times higher. Okay, we have to unpack the mechanics of that.
Yeah.
Why? What is a hybrid student studying that commands a massive 3x revenue multiplier?
Primarily, these hybrid students are pursuing an accelerated Bachelor of Science in Nursing, commonly referred to as an ABSN.
Let's walk the listener through the actual user journey of an ABSN student. Like, who is this product for?
It is specifically designed for highly motivated adults who already hold a bachelor's degree in another field.
So someone with a degree in, say, biology or communication.
Or business.
Yeah.
But they have decided they want to pivot their career and become a registered nurse.
Got it. So this isn't an 18-year-old fresh out of high school.
No, not at all.
This is a 28-year-old or a 35-year-old who sees the massive nursing shortage in the United States and wants a direct pathway to a high-paying, stable healthcare career.
Precisely. And because it's a premium-priced, highly specialized medical program that accelerates their entry into a lucrative workforce, it naturally commands higher tuition.
Makes total sense.
But here's the logistical hurdle. You cannot just put a nursing degree completely online.
Right. You can't learn how to draw blood or run an IV through a Zoom screen.
Exactly. You need physical laboratory sites, you need clinical practice with actual medical dummies, and eventual patient interaction.
Okay, so that is what these 47 hybrid locations are.
Yes.
They're not traditional college campuses with dorms and football stadiums.
No, they're highly specialized off-campus classroom and laboratory sites situated in strategic geographic markets.
So the mechanical flow for the student is they do all the didactic learning, the textbook reading, the lectures, and the testing online from their own home.
Correct.
But a few times a week, they drive to their local physical GCU hybrid site to perform the intensive clinical skills in a simulated hospital environment.
That is the hybrid model. And despite the premium price tag, the value proposition for the student is undeniable.
Yeah, I should see that.
They get a fast, flexible, direct path to a high-demand career without having to quit their life and move to a traditional university campus.
And for the company, the economics are staggering. I mean, even though these physical sites require upfront capital expenditure.
Which is significant.
Right. You have to sign a commercial lease, build out the hospital simulation labs, buy the medical equipment. But the site level profitability is incredible once they are up and running.
Oh, absolutely. CFO Dan Bacchus noted on the call that on a site-by-site basis, margins could be 20% plus as they scale.
And they are scaling very aggressively. They currently operate 47 of these hybrid locations, but management stated on the call that their long-term goal is to hit 80 locations nationwide.
Let's do the math on that for the retail investor.
Yeah, let's credit the numbers.
They want about 300 nursing students per location, plus they're planning to add another 300 students per site in other allied healthcare-related programs. If they hit that 80 location goal, and fully mature those sites with 600 students each, that is nearly 50,000 students in the hybrid platform alone.
And keep in mind the multiplier. Those are 50,000 students generating 3 times the revenue of a standard online student.
It's a massive revenue engine.
It really is.
Furthermore, you have to look at the massive funnel feeding this system.
What do you mean?
The prerequisite business. The general education anatomy, physiology, and microbiology courses designed to get these career changers academically prepared to even enter the nursing program.
Right. They have to take those first.
Yeah, and that prerequisite funnel has already enrolled more than 25,000 students to date.
Wow. So they have 25,000 people taking online prerequisites, paying tuition for that, who are then heavily incentivized to funnel directly into the high-margin, 3x revenue hybrid nursing program.
Exactly.
It is a brilliant, vertically integrated customer acquisition model.
It truly is.
Okay, I have to push back here, though. I love the nursing model. The unit economics make total sense. But I am looking at this earnings transcript, and management isn't just focusing their firepower on nursing.
They are definitely expanding.
They are expanding wildly into totally different territories. In September of this year, they're opening an 11th college, the College of Construction and Industrial Technologies.
Yes, the trades.
Right. They are offering 2 bachelor's programs and 11 different one-year certificate programs for the trades. And if that wasn't enough, they are simultaneously planning to open a law school in the fall of 2027, a 12th college.
It is a massive expansion of scope, certainly.
I just have to ask, are they spreading themselves entirely too thin?
It's a fair question.
Because as an investor, when I see a management team trying to run an accredited nursing program while simultaneously trying to be a trade school for construction workers, while simultaneously trying to launch a law school for attorneys, alarm bells go off in my head.
Yeah, it can look a bit scattered.
Right. It sounds like classic corporate empire building. It sounds like they lack focus. How does a single management team not drop the ball when they are juggling such wildly different regulatory environments and academic disciplines?
I understand the skepticism. On the surface, opening a trade school and a law school in the same breath sounds completely erratic.
It really does.
But if you look closely at the regional macroeconomic data and the labor market shortages, this is actually a highly calculated barbell strategy.
The barbell strategy.
Yeah. They aren't just throwing darts at a wall of random academic disciplines hoping something sticks. They are surgically targeting severe labor bottlenecks.
Okay, when you say barbell strategy, it makes me think they're aggressively weighting the 2 furthest extremes of the labor market.
That's exactly it.
So on one end, you have blue-collar physical trades like construction and manufacturing, and on the other end, you have white-collar prestige like a law school. Is that what they're doing?
That is exactly the architecture of a barbell strategy. Let's break down the mechanics of the blue-collar side first.
Okay, let's do it.
You have to look at the local economy. Grand Canyon University is located in Phoenix, Arizona.
Right.
Over the last few years, Arizona has become a massive hub for advanced manufacturing. Just 20 minutes from the GCU campus is TSMC, the Taiwan Semiconductor Manufacturing Company.
Oh, right, because of the GPS Act.
Exactly. They are building massive new microchip fabrication facilities fueled by the GPS Act. You also have Amkor Technology building huge packaging facilities.
Right. There are literally tens of billions of dollars pouring into the Phoenix desert to build out domestic semiconductor manufacturing.
And what does that create? An immediate, desperate shortage of skilled tradesmen.
They need people to build these places.
They need electricians, welders, HVAC technicians, and advanced manufacturing operators to build and run these facilities. The local economy is screaming for this labor.
Okay. So the College of Construction and Industrial Technologies isn't some random vanity project.
Not at all.
They are building one-year certificate programs to feed an immediate, insatiable local demand for tradesmen.
Precisely. These one-year certificate programs are highly attractive to students because they guarantee immediate, high-paying employment upon completion.
Because the jobs are waiting for them.
Right across the street, basically.
Yeah.
And for the university, these programs have incredible retention rates and are very profitable to run once the initial shop floors are built.
That makes total sense.
Now look at the other end of the barbell, the white-collar law school.
Yeah, how does a law school fit into this narrative of labor shortages? Are we really short on lawyers? I feel like we have too many lawyers.
Well, in specific regions, yes, we are very short. There is a severe documented shortage of attorneys in Arizona and the greater Southwest, particularly in public defense, prosecution, and rural legal services.
Oh, wow.
Yeah. GCU isn't just acting on a whim here. They have been working closely with the Arizona Supreme Court to develop this initiative.
Wait. The Arizona Supreme Court is actively collaborating with a private education company to open a law school.
Because the state judicial system desperately needs the pipeline of legal talent.
That is wild.
It is. But the genius of a LOPI strategy isn't just opening a standalone law school. It's how they are mechanically integrating it into their massive undergraduate pipeline. They will utilize 3+2 and 3+3 academic tracks.
Let's define those tracks, because that is a massive financial lever for the student.
A 3+2 or 3+3 program is an accelerated academic pathway.
Okay.
It allows a student to seamlessly earn both their bachelor's degree and their graduate degree, in this case, a Juris Doctor, in 5 or 6 years instead of the traditional 7.
Wow, okay. Let's do the math on that for a typical middle-class family.
It's significant.
Yeah, if you can shave a full year or two off of a student's education, you are saving them a year of undergraduate tuition, a year of room and board.
Thousands of dollars.
And you are getting them into the workforce, earning an attorney's salary a full year earlier. The opportunity cost savings are massive. It is a financial hack for the student.
Absolutely. And look at the mechanics from the company's perspective.
Right. How does LOPE benefit?
Well, offering an accelerated 3+3 law track massively boosts their pre-law undergraduate enrollment. High-achieving high school students are drawn to that guaranteed accelerated pathway.
Because it's such a good deal.
Exactly. And once those students are the GCU ecosystem, it effectively guarantees a captive pipeline of admission-ready candidates for the new law school.
Which lowers their customer acquisition cost, their CIA, to near zero for the graduate program.
Precisely.
They don't have to spend marketing dollars to recruit law students. They just promote their own undergrads.
Exactly. So the barbell strategy is essentially this: ignore the generic, middle-of-the-road liberal arts degrees where the return on investment is questionable.
And where AI is threatening the value of the credential anyway.
Right. Instead, hyper-focus on the extremes jobs that require physical presence, like construction or strict state licensure, like nursing and law.
This brings us to a huge point about their economic moat. Over 70% of GCU's online students are pursuing degrees in fields that require state licensure.
Healthcare, counseling, social work, teaching, accounting.
Let's stay here for a minute because a retail investor might look at an online education stock and think, well, the barrier to entry is virtually non-existent.
Right. Anyone can start a website.
Exactly. Anyone can throw up a series of recorded video lectures, build a multiple choice quiz system, and call it an online college. But when a degree requires licensure, the mechanics change entirely, don't they?
It changes everything. It transforms a commodity product into a highly defensive monopoly.
Give me an example.
Let's take counseling, for example. Well, the gold standard accrediting body for counseling degrees is CASEREP, the Council for Accreditation of Counseling and Related Educational Programs.
Okay. And without CASEREP accreditation, you can't get licensed as a counselor in most states.
Exactly. Now, to maintain that accreditation, an online program cannot just be multiple choice tests.
Right.
The university is legally mandated to manage student teaching hours, coordinate clinical observation, and verify in-person internships.
Managing that kind of physical, in-person clinical requirement for tens of thousands of online students spread across 50 different state regulatory regimes. I mean, that sounds like an absolute administrative nightmare.
It is a logistical nightmare. Every state has different required hours, different preceptor qualifications, different background check requirements.
That's just endless red tape.
Which is precisely why many legacy universities are actually dropping their online licensure programs. They do not have the technology, the software, or the administrative resources to manage those logistics at a distance.
But LOPE does.
Yes, because Grand Canyon Education spent years and over $300 million building a proprietary, custom-built administrative software system.
Wow.
Yeah, and it's specifically engineered to manage clinicals and internships at a distance.
$300 million. Let's translate that for the investor. That $300 million software stack is the moat.
It absolutely is.
That software tracks the hours, verifies the background checks, matches the students with qualified local preceptors, and ensures compliance with 50 different state nursing and counseling boards simultaneously.
That is the invisible infrastructure that Wall Street often misses. As CEO Brian Mueller pointed out on the call, the licensure requirements aren't going to change.
Right, they're only getting stricter.
Exactly.
Yeah.
The state boards are not going to suddenly allow nurses or counselors to get licensed without clinical hours.
No way.
There are massive labor shortages in these fields, and very few online options exist because it is simply too difficult for a traditional legacy university to build the logistical support network.
So while legacy schools are retreating from these programs because the administration is too hard, LOPE is sitting there with a $300 million net, capturing all of that market share.
Exactly.
That is brilliant. Okay, we have covered the operational strategy, but I want to pivot to the other massive piece of news in this quarter.
The MSA.
Yes, the MSA. It involves some heavy accounting jargon, but it is critical to understand. I am talking about the Master Services Agreement.
This is a fundamental structural development for anyone holding or evaluating the stock. On July 29, 2026, Grand Canyon Education entered into an amended and restated MSA with Grand Canyon University.
Okay, let's reset the table for anyone who might be new to this specific stock's corporate structure.
Good idea.
Grand Canyon Education, GCE, which is the publicly traded ticker LOPE, is an education services company.
Right.
They provide the technology, the marketing, the back office support, and the clinical logistics to GCU, which is the actual nonprofit university.
Correct.
The MSA is the legally binding contract that dictates exactly how the publicly traded company gets paid by the university. So what are the terms of this new deal?
Well, the headline is the duration. It is a 15-year contract effective July 1st, 2026, running all the way through June 30, 2041.
Let's pause on that. 15 years of guaranteed locked-in revenue visibility. You do not see that in the tech sector. You don't see it in consumer retail. You rarely even see it in defense contracting.
It provides an incredibly stable foundation for long-term capital allocation. Furthermore, it has automatic 5-year renewal terms built in unless an 18-month notice is given by either party.
Okay, wow.
But the most important mechanical change for the investor to understand is the fee calculation.
Right. How much are they making?
Under the new agreement, GCE service fees are set at exactly 60% of GCU's tuition and academic-related fees.
A flat 60% cut of the top line.
Okay, but I saw a specific line in the earnings transcript that gave me pause.
What was it?
Management estimates that this new MSA will actually reduce GCE's annual service revenue by about $20 million.
Yes, they did say that.
If I am a retail investor and I see a contract revision that lops $20 million off my company's top line, my immediate instinct is to panic. Did they just take a massive pay cut? And that is exactly why we need to translate the accounting reality here. Investors absolutely should not panic.
Okay, why not?
Because the impact on actual operating income, the actual cash profit the company gets to keep at the end of the day, is estimated to be less than $1 million per quarter.
Okay, you have to explain the mechanics of that. How is that mathematically possible? You lose $20 million in gross revenue annually, but your actual profit only drops by less than $4 million a year.
It comes down to the expenses that were simultaneously eliminated in the contract renegotiation.
Oh, I see.
Under the old agreement, GCE was required to make various reimbursement payments back to the university for specific academic-related costs.
Like what?
For example, GCE might have been paying for specific faculty software licenses or reimbursing the university for certain shared administrative overhead.
Ah, I see. So money was flowing to GCE as revenue, but then GCE was immediately sending a chunk of it back to the university as an expense.
Exactly. Under the new 60% flat fee structure, those complex academic reimbursement payments are entirely eliminated.
Clean break.
Yeah. The university just keeps a slightly larger share of the tuition up front, the 40%, and pays for its own software and overhead.
So it is essentially an accounting reclassification. It's a wash.
Totally.
GCE takes a haircut on the gross revenue number they report, but they also shed the corresponding expense line on their income statement, so their bottom line operating margin is protected.
Precisely. Furthermore, the amended MSA eliminates GCU's ability to terminate for convenience and removes any related early termination fees.
So they can't just back out.
Right. It radically simplifies the relationship, secures the contract for a decade and a half, and removes the existential risk of the university just deciding to walk away on a whim or find a new vendor.
So that top line drop isn't a real loss.
No, the $20 million top line reduction is just accounting noise. The less than $1 million quarterly operating income impact is the true signal.
That is fantastic context and a perfect example of why you can't just read the headlines. You really have to understand the mechanics of the income statement. And that perfectly transitions us into looking ahead. Because historical numbers are great, the Q2 beat was fantastic, but the stock market is ultimately a forward-looking mechanism.
It only cares about the future.
Exactly. What is management promising for the rest of 2026?
Well, management updated their full year 2026 guidance to include this Q2 revenue and earnings beat.
Okay.
The net mechanical result is that they are projecting adjusted EPS to be 14 cents above previous consensus estimates for the full year.
So they aren't treating Q2 as a one-off fluke. They aren't saying, we had a great summer, but winter will be tough. They are baking that 14-cent beat permanently into the entire year's forecast.
Yes. They continue to anticipate robust new online enrollment growth in the mid to high single digits for the second half of the year.
That's solid.
But if you really want to understand management's true confidence level beyond the carefully worded PR statements, you have to follow the money.
Right.
You have to analyze their capital allocation strategy.
Oh, you are talking about the share repurchases. This was, without a doubt, the most aggressive financial signal from the entire earnings call, in my opinion.
It was massive. In the second quarter alone, management repurchased 471,000 shares of their own common stock at a total cost of approximately $75.3 million.
$75 million in a single quarter.
And they didn't stop there. The quarter ended June 30th, but between July 1st and the earnings call on July 30th, they bought another 169,000 shares.
You just kept buying.
They still have $124.1 million remaining on their current board authorization for buybacks.
Okay, for the retail investor listening, let's break down the mechanics of a share buyback and why it matters to you. Think of a company's total profit, like a large pizza.
Okay, I like pizza.
And the total number of outstanding shares as the number of slices that pizza is cut into. Management aggressively buying back their own stock is like them buying up slices of that pizza and literally throwing them in the trash.
Or eating them.
Or eating them, right. The size of the total pizza doesn't change, which means the slices that you, the retail investor, already hold just became mathematically larger.
Exactly.
Even if the company's net income stays perfectly flat next year, your specific share of those earnings just went up.
That is the exact mathematical mechanism. By reducing the denominator of the share count, they artificially force the earnings per share higher.
Right.
But in LOP's case, the net income isn't flat. It is growing by double digits.
Oh, right.
So you are getting a double compound effect. Your slice of the pizza is getting wider, and the pizza itself is getting larger.
And the reason a management team does this is because they believe their stock is mathematically undervalued.
Yes.
The board is essentially saying, the best possible return on our cash right now isn't a new marketing campaign, it isn't a new building, it is buying our own equity.
Exactly. They believe the stock is materially undervalued based on their free cash flow yield and their enterprise value to EBITDA ratio compared to other S&P 500 companies.
Let's translate enterprise value to EBITDA really quickly.
Sure. Enterprise value is basically the total price tag of the entire business if you were to buy it outright. So market cap plus debt minus cash.
Okay.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is Wall Street's proxy for the raw operational cash flow a business generates.
Got it.
So EV to EBITDA simply asks, how many years of current cash flow would it take to pay for the entire purchase price of the company? LOP's board believes their ratio is too cheap compared to the broader market.
And they are so confident in that assessment that they are doing something incredibly aggressive. They are actually taking out a new line of credit expected to be finalized by mid-August, specifically to allow them to continue buying back stock at current or higher levels.
Which is a really bold move. They already have $274.5 million in unrestricted cash and investments on the balance sheet, but they are intentionally adding a credit facility to accelerate the buybacks even further.
Wait, let me get this straight. They are taking on corporate debt, literally borrowing money, just to buy back more of their own stock.
Yes, it is a highly aggressive, leveraged capital return strategy. CFO Dan Bacchus actually noted on the call that investors should anticipate a slight decline in interest income in the coming quarters.
Why?
Simply because their cash balances are dropping so rapidly due to these aggressive share repurchases.
That is the ultimate put your money where your mouth is move. They are willing to eat a little interest expense because they are that certain the equity is cheap.
Absolutely.
But while we are looking at guidance in the income statement, you also highlighted some short-term accounting noise in the transcript that retail investors desperately need to be aware of for Q3 and Q4.
Yes, very important.
Things that might make the quarterly results look a little weak if you don't understand the underlying mechanics.
This is critical for anyone who tracks this stock quarter to quarter. You need to be prepared for some significant revenue timing adjustments. First, about $1 million in revenue was accelerated into this current second quarter that was originally scheduled to land in the third quarter.
Okay, so when Q3 rolls around, it will look $1 million lighter than expected.
Right, but the much bigger shift is an $8.3 million revenue move from the third quarter into the fourth quarter.
$8.3 million. Why? Did they lose thousands of students for the fall semester?
No, it has absolutely nothing to do with student demand, enrollment drops, or fundamental business weakness. It is purely an artifact of the academic calendar and GAAP accounting rules.
Okay, explain that.
GCU's fall semester for its traditional ground campus is scheduled to begin and end exactly 6 days later this year than it did last year.
6 days. And that moves $8.3 million. Walk me through the accounting mechanics of that.
Well, under GAAP rules, specifically the matching principle, a university cannot just recognize all the tuition revenue the day the student's check clears.
Yeah.
Revenue must be recognized proportionally over the exact period the classes are actually taught. Because the entire semester is shifted 6 days deeper into the calendar year. 6 days worth of daily revenue recognition is pushed out of the Q3 accounting period and into the Q4 accounting period.
So the cash is still in the bank? The students are still in the seats. It is literally just the accountant moving a spreadsheet entry from September to October.
Precisely.
Yeah.
So if you are an investor, write this down when Q3 earnings come out. Do not panic if the top line revenue looks a little soft compared to Wall Street estimates.
Right.
That $8.3 million is locked in. It is just going to show up in Q4. It's an accounting quirk, not a fundamental flaw.
Okay, that is great context. And there was one more accounting quirk you flagged regarding taxes and G&A expenses, right?
Yes. In the third quarter, general and administrative expenses are expected to artificially increase by $5 million.
A $5 million spike in G&A. That's a decent hit to the margin line. What is driving that?
It is a contribution made in lieu of state income taxes. Some states allow corporations to make charitable contributions to specific state-approved educational or community funds.
Okay.
And in return, the corporation receives a dollar-for-dollar tax credit against their state income tax liability.
Okay, I follow the mechanics. So how does that hit the income statement?
When they make the contribution, their G&A expense goes up by $5 million in Q3. But their income tax expense is simultaneously reduced by an equal $5 million. Because of how tax provisioning works throughout the year, 75% of that tax reduction hits in Q3, and the remaining 25% hits in Q4.
So again, it is a complete wash on the annual bottom line.
Totally.
The net profit doesn't change by a single penny. Management is just moving numbers between the G&A line and the tax expense line on the income statement to optimize their state tax strategy.
Exactly. As a retail investor, you have to be sophisticated enough to look past this short-term accounting noise. The 6-day calendar shift, the tax credit swap, ignore it.
Focus on the big picture.
Right. Focus purely on the long-term mechanics, the cash flow generation, the leveraged share repurchases, and the structural margin expansion. For context, their effective tax rate for the full year is projected at 23.2%, which is highly manageable and predictable.
Okay, we have covered a massive amount of ground today. We started with the apocalyptic landscape of traditional higher education.
We did.
We unpacked the massive Q2 earnings beat and the 110 basis point margin expansion. We dug deep into the unit economics of the hybrid nursing program and the logistical nightmare of clinicals that LOP solved with a $300 million software moat.
That software is key.
We debated the barbell strategy, analyzing the Phoenix manufacturing boom and the Arizona legal shortage. We broke down the mechanics of the 15-year locked-in MSA, and finally, the hyper-aggressive, debt-fueled share buybacks.
It's been a ride.
Which brings us to our ultimate conclusion. What exactly should you, the retail investor, do with this stock?
I will take a distinctly opinionated stance here based on the data we've reviewed.
Lay it on me.
This earnings call signals a heavily bullish long-term outlook. LOPE is successfully acting as the agile, fast-moving technology company displacing bloated legacy incumbents.
Yeah.
They're not just surviving the structural shifts and the chaos fatigue in higher education. They are actively weaponizing it to take market share from their slower competitors.
I completely agree with that assessment. So let's break down the actionable takeaways. Let's say you are already a holder of LOP stock. You've owned it for a year or two. What is the play here?
If you already hold the stock, the aggressive share buyback program essentially puts a concrete floor on your stock price.
Because they're just shrinking the float.
Right. Management is actively, aggressively reducing the share count. Remember the pizza slice analogy?
Yeah.
Even if you just sit on your hands, management is mathematically increasing your earnings per share quarter after quarter.
It rewards your patience while you wait for those hybrid clinical locations to scale up.
Exactly. They are currently at 47 locations, moving toward a long-term goal of 80 sites. The heavy capital expenditure to sign leases and build out those hospital simulation labs is happening right now.
Right, they are spending the money now.
They guided for $30 to $35 million in CapEx for this year. but the cash flow harvest from those nursing students paying 3 times the revenue will continue for a decade. The advice for holders is simple: hold the stock, let management shrink the float, and watch the hybrid sites mature.
And what if you are a prospective buyer? What if you are listening to this Talk Tickers deep dive, you understand the mechanics now, and you are considering taking a position in LOPE for the very first time?
If you are considering initiating a position, the 15-year master services agreement we discussed provides a level of massive, predictable revenue visibility that should give you immense confidence.
Yeah, that 15-year lock is wild.
That kind of contractual certainty, locking in 60% of tuition economics until 2041, is rare in any sector of the market, let alone education.
It really is. It de-risks the investment significantly.
Furthermore, their strategic barbell pivot toward premium-priced, high-demand licensure programs like the Accelerated Bachelor of Science in Nursing and the upcoming law school justifies paying a premium valuation for the stock.
Right.
They are actively refusing to compete in the race to the bottom for generic, commoditized online liberal arts degrees. They are building an impenetrable regulatory moat around state-licensed required professions.
The moat is the clinical logistics. They are doing the hard, messy, real-world administrative stuff that legacy schools are running away from. It's a fantastic setup. But before we wrap up today, there is one more thread I want to pull.
Oh, what's that?
Something that came up during the Q&A portion of the earnings call that I found incredibly provocative regarding the future of the internet itself.
I assume you're referring to the analyst's question regarding the threat of artificial intelligence.
Yes. An analyst asked management about the existential threat of generative AI, like ChatGPT, on their student acquisition model.
That's a great question.
Because historically, the mechanics of online college recruitment rely heavily on search engine optimization. A prospective student Googles best online nursing degree, they click a Google ad, they fill out a form, and they get a call from an admissions rep.
Classic lead gen.
Right. If generative AI disrupts traditional Google search and people stop clicking on traditional web links, does that entire lead generation model just collapse?
It is a massive existential risk for the entire online education industry. Customer acquisition costs are tied directly to the efficiency of Google search.
Exactly.
But CEO Brian Mueller's response highlighted a structural advantage that I think the broader market is severely underpricing right now.
He noted that over 30% of GCU's new student starts, and he expects it to grow to 40% very shortly, have absolutely nothing to do with traditional internet marketing, SEO, or Google lead generation.
Right. Those students are generated through an internal outside development team that works directly face-to-face with over 6,000 corporate and healthcare organizations across the country. We are talking about local school districts, massive hospital networks, community counseling centers, and military bases.
It is a B2B model, business to business. They aren't trying to catch random individuals browsing Google late at night.
No.
They are going straight into the HR department of a massive hospital system and saying, we know you have a severe nursing shortage. We have a pipeline of clinical logistics ready to go. Let's set up a corporate partnership to upskill your current staff.
Which completely shields a massive chunk of their revenue from the degradation of internet search efficiency.
That is so smart.
Well, other online universities are going to watch in horror as their marketing acquisition costs skyrocket because AI is scrambling the SEO landscape. LOPE is sitting comfortably on 6,000 direct relationship-based corporate partnerships.
Which brings up a fascinating thought experiment for you guys listening. As AI completely disrupts traditional internet marketing over the next 3 to 5 years, could LOPE's B2B corporate partnership model actually make it the most AI-resilient education stock on the market?
It is a highly compelling thesis. The B2B relationships bypass the internet entirely. And furthermore, when prospective students do use AI platforms to research institutions, Mueller noted that their PR and marketing teams are actively positioning the university's data online so that, as he put it, the best stories come out in the AI's aggregated response.
Right. They are feeding the AI the data points about their honors college, which is actively pulling students with 4.1 GPAs away from Ivy League schools.
Exactly.
They are feeding the AI the press releases about the new law school and the massive investment in the Arizona construction trades.
They are deliberately engineering the exact narrative of agility, relevance, and workforce readiness that we have discussed throughout this entire analysis.
Which brings us right back to where we started our conversation today. If the broader higher education landscape is a chaotic, muddy demolition site right now, full of legacy institutions paralyzed by chaos fatigue, Grand Canyon Education is the precision engineering firm building a skyscraper right in the middle of the rubble.
Very well said.
They are finding the signal in the noise.
They certainly are. And the financial metrics from Q2 absolutely prove it.
Thank you for tuning in to this Talk Tickers deep dive. We covered a massive amount of technical ground today, from the mechanics of 110 basis point margin expansions and 15-year MSAs, to hybrid nursing unit economics, debt-fueled share repurchases, and the AI-resilient B2B moat.
Lots of data to chew on.
The next time you look at your portfolio, keep digging into the mechanical numbers, learn to look past the short-term accounting noise, and ask yourself one fundamental question. In a world of legacy collapse and macroeconomic chaos, how much of a premium are you willing to pay for agility? We'll see you next time.